Hello and welcome to this week's episode of Nucleus Investment Insights. Today's episode is called Who is More Believable? Central Banks or Interest Rate Markets? On the agenda, we'll discuss how central banks around the world keep raising rates, but despite this, markets keep pushing higher. Today, we'll examine the four most likely scenarios and what each of these might mean for markets and investors. Today, as always, I want to welcome the co-founder and chief investment officer at Nucleus Wealth, Damien Klassen. Welcome.
Hey, Sam. How you going?
Good, thanks. How are you going?
Yeah, not too bad.
Good to hear. Good to hear. Today, I also want to welcome Nucleus Wealth's chief strategist and co-founder, none other than David Llewellyn-Smith. Dave, welcome.
G'day, Sam. Nice to be here.
Good to have you back. It feels like it's been a while.
Well, that's New Year for you.
Yes, indeed. Excellent. My name's Sam Kerr. I'm the Senior Financial Advisor at Nucleus Wealth. For those listeners that don't know, Nucleus Wealth is an Australian active and passive investment manager. We're a global macro investment house and use the insights shared in this podcast to construct and manage our active portfolios. We're also the first to offer passive direct indexing in Australia, which has been labelled ETFs 2.0, as you can customize your chosen index with around 50 different ethical, sector, and asset class screens that we have on offer across all the active and passive portfolios. Just a quick housekeeping message. If you enjoy our content, please subscribe to our YouTube channel and click the bell below to be notified when we go live or have a new episode recorded. We are live every Thursday at 12:30 Sydney, Melbourne time. So jump onto the Nucleus Wealth YouTube channel and you can ask any questions that come to mind, and we'll do our best to answer them during the show. You can also follow us on your preferred podcast platform, as our show is available on all the majors. And if you'd like to see the slides in more detail, we'll post them in the show notes this afternoon, and you can view these at nucleuswealth.com/webinars. So now we've got those formalities out of the way. Damo, over to you to get us started.
Yeah, so what we really wanted to focus in on today is this idea that central banks are actually relatively uncertain, in terms of what they're trying to say. They started with some transient. They switched to saying, no, this inflation's here to stay. It looks as if now some of these elements of inflation are coming back quite quickly, and so sort of raising the specter that, well, maybe they were transient, and especially if it is inflation from lockdowns and supply chain problems that they could reverse very quickly. On the flip side, particularly in the US, we've seen wage growth there, and we're seeing low unemployment around the world. And so the other side of it is, maybe inflation expectations are becoming entrenched. We've had enough inflation that we're going to see continued wage rises, and so they need to keep stamping out. And so that's central banks sort of trying to give messages, but they are there is some confusion in terms of what's happening from their perspective. On the same, by the same token, markets are confused as well, and so and they're certainly giving different signals in terms of central banks are sort of saying that they're going to keep interest rates high for a considerable period of time, whereas markets are effectively pricing in that they won't. That you'll see interest rates fall over the next in the second half of 2023. And so, and I don't think we've ever had as many people sort of forecasting recession as what there is at the moment. So, with all that in mind, what we wanted to do is sort of run through four different scenarios of different outcomes that could that what we could see, and sort of assign what we're thinking the probabilities are to those, and what types of stocks you want to own if you think that scenario is the most likely. So the four big ones, one is that we sort of see the Fed reverse quite quickly. So, we start seeing greater signs of downturn, inflation falls, and possibly we could get continued deflation in the goods, possibly deepening, and the inflation that's in the services comes out, wages growth comes back, and the Fed effectively panics and decides that they've done too much and needs to reverse. So that's a relatively low probability outcome, but very positive for stocks. The next one is that they're sort of going through a bit of a pause, and then start tentatively sort of reversing into the third and fourth quarters of this year, and that's largely what the market's got priced. The third one is similar in that they pause, maybe taking a little bit longer to pause, and then they don't start reversing until right at the end of 2023. And then finally the case where they raise rates for a little bit and then they just sort of pause and just watch and don't do any interest rate cuts for in 2023. So that's the interest rate cuts are 2024 or beyond. And so we just want to look at those sort of four scenarios and look at what the outcomes are, what could cause them, and take it from there. So with that, I don't know, is there anything else in summary, Dave, before we jump into scenario one?
No, that's very good, Damo.
No, I'll over to you then for scenario one, the Fed flip.
The Fed flip, yes.
Yeah.
So basically, we're sort of parsing what we think would be the asset implications in each scenario, and therefore what the allocations implications are. So in scenario one, I think if we did see the Fed flip fast and abandon QT as well, then we would see I think a very sharp fall in treasury yields. So bonds would rally very strongly, and you'd see a seriously wild stock market rally. I think probably focused around growth, which is typically technology, because the argument the dominant argument would be that lowflation was back, and so long duration assets would be fashionable, and so profitability in the near term isn't so important a factor, and so probably the crazier the tech company, the higher it would go. The other part would be cyclicals would rally a lot too. In this scenario, kind of sending this globally would be the DXY, or that's the US dollar index, would get pulverized, I think. And that would immediately, put China's rebound into the center of global growth. Commodities would fly just on the falling US dollar, even though I suspect that the Chinese rebound won't be commodity intensive. I think in this scenario, at least for 12 months or so, that wouldn't matter. And so commodities would be off to the races. However, this one comes with a couple of caveats. We would either end up back in the Macquarie Bank's Victor Chevette scenario of a resumption of global disinflation, and growth would follow the new stimulus back up, but inflation wouldn't, and we'd replay the last cycle, basically. This is not implausible because we basically agree that the structural backdrop for inflation is still disinflationary for many reasons we've discussed over time, such as fading demographics, China going ex-growth, technology revolutions, what else? Inequality, these various structural things that have kept inflation so low for so long, we think would win out. We think will win out in the end.
Yeah, and one of the key sort of headwinds to that, we think, is not quite as much of a headwind as it gets made out. I think most of the structural inflationists sort of talk about deglobalization as being a key driver of inflation. I guess my take is that, look, deglobalization is only really going to happen with being forced by governments, and there will be a certain element of people moving things out of China, but nobody's going to sort of move say, they're producing a widget at $10 in China and selling it for 30 in the US, nobody's going to willingly say, okay, I'm going to start producing it at $20 back in the US. They might go to Bangladesh or Vietnam or Mexico or pick another country where the costs are a lot more similar. Or they'll bring it back to the US and it'll be largely automated where the costs will be close. But the caveat to that is you'll see what's happened with this sort of Build Back Better program and some of the CHIPS Act, in that you'll see quite large incentives in terms of tax incentives or R&D incentives and things like that given to the companies in order to bring back that production. And so while the costs might, maybe it's cost you $10 in China to produce and $14 or $15 in the US to produce, but if you get a bunch of tax breaks and there's tariffs still on the Chinese one, then the whole thing sort of nets out to being roughly the same cost.
Plus it would be capital intensive, not labor intensive, with all the automation. So in the end, that's disinflationary.
Yes, exactly, and especially over the especially going forward is that most of the manufacturing we've seen come back to the US. We've seen a lot more manufacturing come back than what we've seen jobs growth in that area. So it's already quite intensive, and that once you've got a machine in place, they tend to get more productive over time, and the costs just keep coming down.
So there is an alternative outcome here, however, which is that we're wrong, and sticky inflation that is still apparent in the US. I don't want to mislead you. We can see that loud and clear, especially in services. Forms a base upon which inflation could rebound really quickly with a lot of new credit and money rushing into markets and a rise in global demand. So in that event, you get the nightmare scenario for asset markets, which is that before the year is out, the Fed's forced to start tightening again. So there are two sort of polarized outcomes in this scenario as well. So we don't put a high probability on either. Basically, we think that this scenario is only about a 10% probability. Even though we're sort of deflationist, I guess, in a sense, we think it'll take more time. We don't think that the Fed will come down quickly, in part because of the sticky inflation that I just discussed. And so I don't think, the scenario in which the Fed pivots hard and then is forced to repivot is likely. So we put that as a relatively low probability scenario.
The other thing is worth noting is, one of the key lessons over the last few years is that, and we've known for a long time that monetary policy, gets to the point of pushing on a string where they're cutting rates or trying to provide more stimulus, and it actually doesn't spark inflation because of all these other factors we've spoken about in the past. So, and that's what we saw from 2010 to 2020 effectively. So we've sort of learned that. The other thing, though, is that we've relearned that, hey, fiscal policy really does work. When you throw lots of money at people, they get out and spend it, and that gets things going again. And so the question for all of these is, and maybe not as much in this scenario, but as we start looking at some of the other scenarios, a lot of this sort of depends upon what the government responses are going to be in terms of fiscal policy. So at the moment, they're all pulling back and spending less than what they did, and that's pulling demand out of the market. If governments turn back into any sign of trouble, they all of a sudden embark on massive transfers to individuals, then I think we're sort of all back on. But that's again probably unlikely. At the moment, we think most governments are trying to pull back. And where they're not, sort of say in Europe, a lot of the spending is based around the specific energy problems they have there and trying to transition that faster. So it's a sort of big capital spend to try and sort of switch across as opposed to sort of direct transfers to. Oh, sorry. I guess
we had a very, very, very sharp fiscal impulse fall last year, as you say, as governments stopped spending, and that's still going. But it does diminish as the year goes on. Most particularly in the US, it's still negative through the first half of the year, but then kind of flattens out. can rise a little. Europe is still spending pretty big, but as Damo says, that's a sort of swings and roundabouts spend where it's subsidising various segments of the economy in terms of energy shock and things like that. But that European spending trails off all year and turns negative in the second half. So, the fiscal impulse is definitely flattening out from what was very severe last year. So, it isn't likely to become supportive this year, I don't think. We've got the debt ceiling problem coming in the US, so I can't see that swinging to big spending. And as I said, Europe's already diminishing. China is manning the fiscal pump, but I think that in terms of net demand gain for the global economy will be relatively small. Won't be commodity intensive as property continues to struggle and infrastructure diminishes versus the breakneck pace last year. And so a lot of it basically will be, domestic demand and not really driving much net gain for anybody else. So that's part of the background of these various scenarios that we've cooked up here. So scenario 2, and this is where we are getting into sort of present pricing for the market, as Damo says. The Fed pauses soon and starts cutting in the second half because inflation is whipped in its view, probably in Q3. Whether it would reverse quantitative tightening is an open question. I mean, that's in this scenario, maybe not. It seems a bit strange that they would stop hiking but continue tightening in terms of money printing, but that's plausible. Anyway, in this scenario, again, we would see yields tumbling in this calendar year, going even lower than in scenario 1 and for longer. We're still pretty bearish on corporate profits, even in this scenario, because basically the squashing of inflation, comes with a massive margin squeeze for business. But as we've seen, this is really kind of the core of the rally that we've just seen in the early part of this year. To offset what is a big margin squeeze, we'd probably see a multiple expansion in stocks because we're seeing yields tumble. So, those two more or less offset one another at this point.
And so just to confirm on that, so what we're looking at from that is earnings get cut by 5 to 10% from where they are now, but markets are a lot more. I guess they're looking at more of a soft landing and less of a less of a deep recession and more about a shallow recession or no recession, and so markets basically starting to price in the next cycle and saying, well, yes, earnings are down, but we'll look through that and we'll actually pay up similar multiples to what we saw say a year ago or more, where you might get to sort of 20 times earnings on markets, with a view that earnings will rebound once we're through.
Yeah. And so this is a relatively benign inflation scenario, basically. We're entering sort of the return of disinflation scenarios here. And so, the US dollar is likely to fall, continue to fall for a little while in this scenario, as typically happens at the beginning of a new cycle. I mean, you can pick a number, 5, 10%, and that would, give some more fuel to the emerging market rallies. Probably give commodities a little bit more to run on, but not for long, I don't think, because I think the DXY would flatten out for very long. As basically China's rebound would prove itself to be pretty thin with it, relatively quickly, and so the US would probably still be the growth leader for the new cycle. In this one, you're going to see probably sideways stocks, maybe a little higher, but not a lot. And so you're probably actually better off in bonds in this scenario where there would be, some bigger gains. That said, you probably buy quality.
Yeah, actually, sorry, I didn't talk about the stocks for the last one as well. Just so separating out for the last set, for that first bullish scenario, you're out there buying sort of value stocks and cyclicals, or you buy basically the stocks that have got that tend to have lower margins, and when the economy booms, that's their chance to put through price rises, and when the in terms of cyclicals, they've got the most leverage to economic upside. So
yeah,
so
I did mention that.
Oh, do you? Sorry.
Yeah,
and then then this one's more about saying, okay, now I'm looking for companies where I think the margins are actually going to hold up better than others. So he's talking about this margin squeeze, but it's not going to affect all companies in the same way. And so there's a higher quality companies where they should be able to hold on to their margins better.
Yeah. So this is a 35% probability in our view, so it's quite a reasonable prospect. And so, it factors into how, reasonably, it's material to how we're thinking about our asset allocations at this point. So scenario 3 is a more exaggerated version of 2, and is still quite high probability in our view. So these two scenarios are the base case, basically somewhere in between these two. In this one, we'd get even more relief on yields.
So I guess actually just to confirm though, so what we're saying is that the Fed waits a little bit longer to pause.
Oh yeah, sorry, of course.
And then pauses for longer. So you get like 6 months or so of these higher interest rates. Now at that point, you're locking in a bigger recession, and you're locking in more downside, more potential for something to go wrong. We don't think there's a lot that's gonna. We don't think there's massive imbalances out there. Excluding China, which has sort of got its own issues and potentially can skirt them for a little bit longer. But in terms of the US corporates and US households, not too bad in terms of where they're sort of sitting in terms of leverage and I guess the amount of irresponsible lending out there is not as high as it's been in other cycles. Australia, that's not quite as true in Australia, but it's certainly still Australia still looks all right relative to some of the other cycles. But it's things are worse in Australia than what you'd say in the US. But
yes, but the stuff on yields should actually read a plateau, even a grind higher for a while before the Fed starts cutting, and that goes hand in hand with what Damo's just described in terms of having a harder landing, not super hard, but harder. But then, because the Fed's really choked off activity, then yields will come down harder afterwards, and so again, bonds over the reasonable horizon look quite attractive, especially relative to stocks. Because the corporate profits are likely to fall a lot more sharply. The margin squeeze could really have its day, and there's no stimulus coming from the Fed in terms of pulling yields down quickly enough to give you a multiple expansion to offset that. So, this is a more bearish scenario for stocks. Again, you would be looking, on the way down to buy quality. You'd want to own defensives before it started. This one, the US dollar, which is a critical feature of how all of this gets transmitted to the global economy, would remain firm, possibly even rally a bit from where it is. Emerging markets, the red hot emerging markets rally we've seen so far would peter out, and there'd probably be a second leg down for commodities. Based on the US dollar and just simply the fact that global growth is going to follow the US into some kind of shallow recession. And again, we put this on a 35% probability. So between these two kind of base cases, we've got kind of a 3/4 probability of the global economy landing somewhere in the middle here.
And just to, I guess, clarify what I mean by the difference between, in the prior one, you're buying quality stocks, and in this one, you're buying quality/defensives, is that in this scenario, we're looking at further downside. So the quality stocks, so their margins are more likely to hold up, and they tend to be stocks that are going to grow a little bit better. And so you will get that, that benefit by holding those ones. But, regardless, when markets tumble, they're still going to get hit more than what we'd call a defensive stock. And a defensive stock is the ones that are sort of more like your utilities and REITs and, the very stable earnings, consumer staples, those types of ones. So, not every single one of those sectors is going to hold up in downturns, but as a group, they will tend to hold up more. And because their earnings are a lot steadier, they tend not to fall in recessions. And so you'd want to be starting to tilt more and more into those defensives under this scenario. So in the prior scenario, because it's probably relatively shallow and could take off, markets could take off relatively quickly. You want to sort of be more tilted into that quality end where you'll still get some pickup. Whereas in this scenario, we're still looking at more downside to stock markets, and so you want to be sort of still having quality in case things turn faster, but bigger exposure to defensives than what you might have had in the prior scenario.
Very good. And so our final scenario, this is really the sticky inflation scenario, where the Fed is forced to keep going for, we think they'll go another 2 at least already, but they forced to keep going to perhaps 4. There are even some pretty large option bets hitting the market up to 6%, which would be, what are they at now? 4, I can't remember, 4.5. Can't remember. Anyway, it'd be a lot more tightening to get to 6. Excuse me. And then, the Fed really sits on everything until it feels like it's crushed the inflation out of the system.
And just to be clear as well, this is what they say they're going to do, effectively.
Yes. Well,
so this is,
yes,
maybe
basically, yes.
Yeah, they're basically saying we're going to raise rates and then we're going to leave them there until we're absolutely sure that,
yes.
the inspector
although their communications right now are as confused as the market, I have to say.
Yeah.
But this is what's in the dot plot anyway.
Yes.
That they put out. So, in this one we get a genuine recession in the US. Corporate profits take a big hit because they're pressured, by falling demand as well as the bottom line pressures. So the stock market's got a big correction ahead of it. Pick a number, but well below, in fact, I'd say very likely below the lows we've had so far, perhaps getting down to 3,000 on the S&P, who knows. The US dollar in this scenario just reverses up for another big rally, possibly even to get as high or near as high as it has been already, which would be a big rise, and maybe to post ultimately what would be a double top. Emerging markets would get flogged. Commodities would fall despite China. The China rally, I think itself, would probably implode. Certainly would suffer a decent correction. We put about a 20% probability on this one transpiring, and similar to the last scenario, in this one you really want to be long defensive stocks and buying quality on the way down.
And largely out of stocks,
And we haven't really.
So whatever stocks you've got left should be the defensive ones, but
we haven't really discussed the asset weights, but they are actually on our front page. We've given you an example of how we scenario analyze these things on the first page of the presentation, which gives you a notion of the various asset allocation percentages that we would use in the 4 scenarios, and this would be the lowest allocation to stocks, absolutely. And then, of course, you would get a big crash in yields ultimately as we go into a new cycle, and the Fed's forced to really slash and burn when it's satisfied that it's squashed inflation out of the system.
Yeah. So, but net effect is, I guess there's a range of different scenarios there that we've spoken about. For one end, is a rush out and buy equities as fast as you can. If the Fed's going to flip and reverse. At the other end, if they do what they say they're going to do, then that's a bad thing for stocks. The markets are pricing that the Fed isn't going to do what it says it's going to do, and so in those ones, there's a sort of depending upon where you sit in terms of that flavour. So as Dave said, we've sort of got that relatively central view. I think there's a overlying that we have some longer term views that disinflation is more likely than inflation, but with the big disclaimer saying, well, if the new mantra for governments now is in recessions and downturns, throw as much money as they can at people, then inflation is going to return. So,
and or other drivers, wars, a good one for fiscal, or the war on inequality, which I don't see a lot going on.
No,
for that one.
But no, that's right. I think the poor people are surrendered there.
I think at this stage the jury's out on what happens to fiscal. It's possible that policymakers kind of eventually sit down and say, well, we don't really want to go through that inflation thing again, so MMT is finished. And we'd be right back to the disinflation scenario. Probably not that bad, because at the end of the day, Polly likes to spend, but not implausible.
Yeah. Yep.
Okay.
Absolutely.
Excellent, guys. I think you've done such a good job of explaining the scenarios. We don't actually have any viewer questions for today, but now we do have our question of the week. So this is for viewers to have some discussion in the comments section over the coming days. The question for this week is, will the Fed lead the market in 2023 or follow it? So feel free to post your thoughts and engage with us and some of our other viewers over the coming days. And now we have the investment implications section. So back to you guys.
Yeah. So do you want me to take this one, Dave? It's largely
Sure.
It's largely where we've talked about before is that, and I guess it's the amalgam of these ones is trying to work out, well, where's my upside, where's my downside. Now, there's not a lot of scenarios where there's lots of upside for stocks. We do think in some of these scenarios, once the downgrades come through and the recession sort of hits and you get that that first shock, then there's some reasonable prospects for stocks on the other side. And then there's just a question about what stage do you start buying and looking into that. So the closer we are to the first scenario, the more you want to be looking at buying stocks, or at least topping up on stocks and not getting too far underweight. And on the other end, if the key one now for us is really starting to see these downgrades come through, and we this reporting season's certainly seen the start of it. We've seen some significant downgrades to earnings just over the last couple of months for 2023. There hasn't been a lot to 2024, so 2023 earnings have come down about 10%. There's still forecast to be about 10% growth for 2024. So I think things are sort of still headed towards our South Central thesis. We'll be sort of watching quite keenly again for this next quarter to sort of double check that's true. So that'll be our first quarter earnings, which not coming out for another 2 or 3 months now. But that's our real focus is in on, are companies managing to keep the margins? What are they doing in terms of downgrades? And what are we seeing? How much effect are we starting to see as people are started getting through their cash, burning through their cash, and taking on the higher interest rates? Are we actually seeing that flow through to demand? And so far to date, it's sort of going roughly as we expected. There's but lots of uncertainty around.
So I'd probably just wrap it up by giving everybody a take on how Australia might fare in these scenarios. Scenario one, where we get a quick reversal from the Fed, is actually a bit of a nightmare scenario for most Australians. Given we would have, a rush to commodities, and capital flying into the Australian stock market. It's, even though you'd be seeing a lot of global disinflationary impacts, it would take a lot longer to arrive in Australia, and we have a business cycle that's running about 6 months behind everybody else, simply because we opened up from COVID much later. And so what I'm really thinking of here is this one might actually force the RBA a little higher, even though the Fed would be coming, panicking and going the other way. The RBA might be forced to go higher first, and so that's in terms of the disinflationary outcome. And of course, if it's sticky inflation and the Fed's forced back up, well, then it's absolute disaster for Australian households, as the RBA is forced to keep tightening, and the housing bust would reach epic proportions.
Having said that, the first instinct is going to be for Aussie shares to go up, because they do tend to act as a growth.
Oh, 100%.
Yeah.
So, but it pushed the RBA up, I think, with it.
Yes. Yeah.
Initially, until some of that global disinflation finally arrived. But our cycle, because it's lagging, wouldn't quite get the opportunity to clean out some of that inflation before, the Fed had pivoted and money started flowing. So that could be quite troublesome for the RBA. Scenario two, moving again towards our base cases. Look, I'm pretty much sold on the idea that Australia's going to have a hard landing at this point. I don't think scenario two will deliver it. Anyway, I just think, owing to the structure of our mortgage market coming out of COVID, which was sort of an unintended consequence of the RBA's venture into quantitative easing with fixed rates, rolling off after it's done, a record pace and size of tightening. We're going to get so much tightening happening so fast in 2022 that, I really fear for the Australian economy. I think a sudden stop in consumption is possible and probably will happen in scenarios 1 and 2.
And 3. Sorry. 2, 3, and 4, isn't it?
2, 3, and 4. Yes. So Australia, it's difficult for Australia right across the board here. At least it's difficult for households. Australian stocks would be fine in the first one, at least initially, although could get troubled by the RBA. But in the other three, it's still quite difficult for Australian households, I think. As the RBA is, the RBA would end up actually coming off harder ultimately, but not before, we had a hard landing of some sort. So,
and actually, just to put that into context, some of that, is around the idea that Australian stocks are starting from an already very, very expensive place as well.
Yes.
That's the other thing that's colouring. Like, if Australian stocks were half the price of what they are now, we'd have a more constructive outlook. But Aussie banks versus world banks are almost at record highs. Like, we've almost never seen Australian banks trade so expensive relative to world banks.
Yeah.
Resources are similar. Industrials are similar, are not at records, but they're in the top sort of 20% of where they've ever been. It's just not starting from a good place.
No, it's not. And there's no pricing of this scenario for Australia at all in the markets. Like, it's not in the bond market either. We have a steep yield curve. We have a little bit of inversion at the front end, kind of from the 1 year out to maybe 3 to 4, but not in a way that's persuasively telling you of a recession that's coming. I think that's mispricing, and so as a result of that steep curve, there's no fear in the stock market either. And so we have these really high valuations. We're priced for perfection across the board. Some of this is the China reopening, I might add. But, you know, we do have some pretty red hot inflation. We have the RBA going really hard. We got this unfortunate mortgage cliff, fixed rate mortgage cliff. A lot of tightening hasn't arrived yet. We've got a record housing bust underway that is only halfway through. And so the market pricing looks completely out of step with where the economy is going, to me.
On that happy note,
Yes.
over to you, Sam.
Yeah, thanks, guys. Obviously, succinctly put there. It's that's going to wrap us up for today. So, thanks for sharing your insights as usual, and we'll talk to you next week.
Thanks, Sam.
Thanks for having us.
Excellent. So we do welcome your feedback on this podcast, especially in regards to future topics. If you do have any ideas, please drop it in the comments section below or send us an email at contact@nucleuswealth.com. Just a reminder, this is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation, please go to our website at nucleuswealth.com/contact and you can book a call with myself. Don't forget to like the video now, and if you know of anyone that might get some value out of today's episode, would really appreciate it if you can please share it with them. And also, if you'd like to see more of our previous episodes and content, head over to nucleuswealth.com/content or subscribe on our homepage for our weekly Nucleus news and investment insights. We do put out a lot of other articles and videos in addition to this podcast. And of course, you can follow us on all major social media. So for myself, Damien, Dave, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.